In 1995, one 28-year-old trader lost $1.4 billion. He took down a 233-year-old bank by himself. He wasn't wrong about the market. He just couldn't control how he responded to losses. Look at this. You're watching a Bitcoin chart. It crashes from $60,000 to $30,000. You feel that same panic rising. What's interesting, the real skill isn't predicting the next move. It's sticking to your plan when every instinct screams at you to react. And that's where trading discipline, the habit of following your own rules under pressure, begins. Let's get into why following your own rules is the hardest skill to learn. Your phone buzzes at 7:30 a.m. A notification reveals that Bitcoin is nearing the $45,000 mark. You know it's just a number, but your heart races. There's an opportunity here, and you've been waiting for this setup. The chart shows a morning gap fade, a move where the price drops slightly after an initial rise, but this time, it's tempting you to enter prematurely. Imagine standing on a balance beam, 5 feet off the ground. You know the steps, you've practiced them 100 times, but suddenly, the hype gets to you. Trading feels like this. That balance beam is your trading plan, and the ground below is every instinct telling you to act now, to jump at the wrong time. When you look at the chart, discipline whispers. It's the voice reminding you to wait for confirmation, to stick to your predefined rules. But then, there's the other voice, the one shouting that if you don't act, you'll miss the move. This is the trader's dilemma, the tug-of-war between emotion and discipline. The hardest skill isn't predicting Bitcoin's next move, it's holding your ground, following your own plan when the pressure mounts. You set your rules for a reason, like waiting for the price to close below a certain support level before you enter. Breaking those rules because of emotional reactions can lead to inconsistency and ultimately, loss. As you look at the chart, the short-term candles flicker with potential, but your plan requires patience. Your rule is not to enter until the price confirms your thesis, your specific reason for taking the trade. This means sticking to your strategy, no matter how tempting the early entry looks. The real opportunity lies not in the thrill of a quick trade, but in the confidence of a disciplined approach. Remember, the market will test you. Every dip, every rally is a chance to practice discipline. Following your own rules isn't just a skill, it's the foundation of successful trading. So the question is, when the market moves, will you? Why does the same plan that worked last week suddenly feel so uncertain today? Imagine you're looking at a Bitcoin daily chart, and the price is dancing around key levels of support and resistance. The chart shows that buyers typically jump in at $30,000, while sellers push back at $45,000. You know these levels by heart, yet every flicker of red and green candle makes you question your next move. That's where discipline comes in. It's about sticking to your strategy, even when the market feels like it's taunting you. Let's say your plan is to buy when Bitcoin approaches $30,000. The market dips towards this level. Your heart races. What if this time it's different? But here's what you've prepared for. You've set your stop loss, a preset price where you automatically get out of a losing trade, just below $30,000. You know the risk, and you've sized your position accordingly. Now, you're not just reacting to every tick. You're executing a plan. This is what separates disciplined traders from emotional ones. They don't chase price. They don't panic sell when the candles turn red. Instead, they trust their analysis and their strategy. The real test of discipline isn't when everything is going right. It's when the market throws curveballs. Can you stick to your plan when fear tells you to run? Can you hold back from revenge trading, taking a bigger, sloppier trade right after a loss when you've just been stopped out? So next time you're facing that chart, remember, discipline isn't about being rigid. It's about being prepared. And prepared traders are the ones who turn uncertainty into opportunity. Still with me? Here's the part that breaks most traders. Picture two traders at their desks. On the left, the disciplined one, calm, reviewing charts. They know exactly when they'll enter and exit. On the right, the emotional trader, clicking through news, scanning every price tick, heart racing each time the market moves against them. So what sets them apart? The disciplined trader follows a plan. They've already set their stop loss and their position size, how much money goes into any single trade before clicking buy or sell. They get that discipline isn't just about making the right trade, it's about knowing when not to trade. Now the emotional trader. They might start with a plan too, but the moment the market shifts, panic kicks in. They drag their stop loss lower, hoping for a turnaround, or they add to a losing position, trying to average down, buying more at a worse price to lower your average cost. That's fear and hope talking, not strategy. Here's a concrete example. The market drops suddenly, The disciplined trader exits at their planned stop loss. Small loss, manageable, done. The emotional trader hesitates. They're convinced it'll bounce back. It doesn't. A small loss turns into a disaster. The cost of ignoring your rules becomes obvious. The disciplined trader lives to trade another day, capital intact. The emotional one is left stressed and bruised, with less to work with. The difference isn't just money, it's mental state. Discipline builds confidence and resilience. Emotional trading breeds doubt and burnout. So, which trader do you want to be? The one who sticks to their rules and survives the swings, or the one who lets emotion drive every click? That choice shapes your entire trading journey. Next, we'll walk through a real trade that shows these differences in action. Look at this. Your notes are scattered across the desk. You're eyeing a short position on Bitcoin, betting the price will drop, suspecting a fake breakout. It's 9:30 a.m. The market's buzzing. You feel confident. Bitcoin is testing a resistance level, a price ceiling it keeps failing to break, and it looks like a prime time to bet on a downward move. But here's where discipline kicks in. Before you place that trade, you have to decide on your stop loss, the price where you exit if the trade turns against you. This is where the 2% rule comes in. Simple idea. Risk only 2% of your account on any single trade. So a $10,000 account means a max loss of $200. No more. 9:45 a.m. Things heat up. Bitcoin gaps down hard, and your stop loss hits in a flash. You might think, how did I let this happen? But you followed the 2% rule. You set your limits before you entered, not after. That discipline stops you from becoming a bag holder, someone stuck in a losing trade, praying it comes back. So why set your stop loss before entering? Here's why it works. Imagine you're playing poker, a card game where you bet on your hand. You wouldn't throw chips in without knowing when to fold, quit the hand and cut your losses. Setting your stop loss is your fold threshold. It's a boundary that protects you from emotional trading, decisions driven by fear, excitement, or ego, not a plan. Without it, you start chasing losses. You move your stop further away in the heat of the moment, hoping Bitcoin bounces back. That's a slippery slope to being on tilt, making bad calls because you're emotionally rattled. Setting your stop early also frees up mental space. You know your risk up front, so you can focus on your strategy instead of stressing over losses. This is how you separate a disciplined trader from an emotional one. The disciplined trader accepts small, planned losses as part of the game. The emotional trader lets losses spiral, reacting on impulse. So next time you're about to take a trade, remember, set your stop before you enter. Respect that limit. It's not just a technical detail, it's a psychological safeguard. Stick to the 2% rule, and you're not just protecting capital, you're building the discipline that keeps you in the game long term. Want to see this discipline play out in other real scenarios? Stick around as we get into more examples that can reshape how you trade. The 2% rule is the bedrock of your trading discipline. Picture yourself walking a tightrope, high above the ground. One misstep and you fall. The 2% rule is your safety net. It says you never risk more than 2% of your total account balance on a single trade. This isn't about limiting ambition, it's about making sure one setback doesn't knock you off your path completely. Consider this scenario. You have a $10,000 trading account. Under the 2% rule, you only risk $200 per trade. That doesn't mean your position size is $200. It means your potential loss, the gap between your entry and your stop loss, shouldn't go past $200. This keeps your account resilient, ready to fight another day, even when a trade goes sour. Here's why this matters. Markets are unpredictable. There's always a fog of uncertainty you can't clear. But with the 2% rule, you're not walking blind. You're working from a guideline that keeps your exposure, how much of your account is at risk, manageable. It protects your capital and your mental clarity. Quick aside, if you found this useful, subscribe. We cover this kind of psychology twice a week. As we go on, you'll see how sticking to this rule can mean the difference between a small setback and a catastrophic loss. Curious how this plays out in real trades? Why leave your trading success to chance? Hit subscribe for more on the mental side of trading. We're here to walk you through every twist and turn. You'll build the discipline to hold your own in the markets. New strategies and real examples drop twice a week. That's enough to reshape how you approach a trade. Here's why it works. This is how you become the disciplined trader you want to be.